Okay, good morning and happy Friday, everyone. Welcome to our 2020 election guide for investors. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And today we are doing our first members only webinar. And because this is the 2020 election coming up, we wanted to do a session for our members. First of all, thank you so much for supporting us and allowing us to continue doing this. But we wanted to provide a forum so that it's a smaller capacity. You guys can answer, we can potentially get to more questions at the end regarding any questions that you have with the election. So let's go ahead and get started. I have quite a bit to cover with you here today, but before we get started, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So in order to take a look at the 2020 election outcome and what our expectations are, we need to first start off by talking a little bit about what I call defining possible outcomes, meaning what are the possible outcomes that we're currently looking at for this election, because all of the views that we have with different industries, different sectors, comes from analyzing how each industry might perform under the different outcomes. So I want to first define that, take a look at where we currently stand, where the polls currently sit on that front. Then we'll take a look at what are the election issues that are currently on the board and how they generally affect the economy from a broad-based perspective that we're looking to analyze, and that broader overview of these issues and how each of the possible outcomes will likely affect these broader issues. Then we'll take a look at individual ones, predominantly around taxes, the trade war, and the environment, which generally speaking are the ones that we see have the largest impact based on the outcome of the election for our economy, for different specific sectors. And then what we'll do at the we'll do a comprehensive review of the different sectors and industries that we see the largest disparity between the possible outcomes of the election and what our views for each one, where we see some opportunities in terms of both positives and negatives. And at the end, we'll open this up for Q&A. I know that we are starting at 9 a.m. and the market's open about 30 minutes from now. So I will want to keep this as short as possible so that you guys can get to your Friday trading. But the primary outcome of this webinar that I'm hoping that you'll be able to take away from this is really where do we see opportunity in the 2020 election outcome. So let's go ahead and get started. And what I'll be sharing with you today is the research that we have been doing over the past couple of weeks regarding the outcome of the election, the different sectors, the different implications that it has on our economy and individual sectors. So I want to share that with you here today. So we have 25 days to go to the election. Now, right now, if we look at the polls, generally speaking, most polls are leading to a Biden victory. Now, we know we saw the same thing here in 2016 with Hillary Clinton. So we're not, even though this is a little bigger in terms of the gap that he has to Trump, right now, the four possible outcomes that we are currently taking a look at is predominantly around Biden with a Democratic sweep of both the Senate and Congress, Biden with a split government, where you have a Republican Senate, but a Democratic Congress, you have Trump with a split government, or you have Trump with a Republican sweep. Now, right now, certainly the polls are showing that it's more likely that at least you have a Biden win. And right now, it's probably looking more likely like a split government rather than a Democratic sweep, but that is still also possible. What looks least likely is a Trump with a Republican sweep, even though that is one of the use cases that we're looking at in terms of when we analyze different sectors and industries, which ones have the most net positive or negative. Some of them do have the biggest net positive or negatives based on that Trump with a Republican sweep. So everything that we're analyzing today is within the context of these four outcomes of the election. So that's the framework that we're currently looking at across everything. So when we look at the 2020 election issues and we take a look at what are investors most concerned about, it seems like by far from a perspective of immediate gains or losses to the market, the biggest concern that most investors have is really a contested vote. And this is something that President Trump has been doing, laying the groundworks for months, if not more likely years, of what he calls voter fraud and the transfer of power if Biden is elected, and what would happen during that time between the contested vote. This is really where historically we have had contested votes, and the markets have generally speaking declined on average about 5% during the time of that contested vote until it was resolved. Whether this is going to be a short contested vote or a very long protracted legal battle, that is yet to be seen. But this is the one part that I think many investors are taking a look at. So just to give you some numbers, the average move to the downside during a contested vote is about 5% in the S&P 500. If this becomes a longer protracted battle, that could very well be a little larger than that, maybe closer to 10%. So this is really where we do see some immediate potential downside pressure and elevated market volatility as a result of just simply going into the election. Everything else is something that we expect to see in the coming months or coming years after the election. But the contested vote is really where I think a lot of investors are concerned about in the short run. So that is certainly one element of trading that I think many investors need to be concerned about, is positioning going into that November election, November 3rd. Now, that's why we still see elevated volatility all the way through November expiration on the VIX. Because investors are concerned, there is put buying for a lot of investors into that election date. Now, when we look at regulations, taxes and regulations are really one of the areas where Democrats and Republicans are pretty much diametrically opposed on this front. So we did want to take a look at how does regulation and taxes affect the earnings of the S&P 500. And what we've noticed in our research is that it's surprisingly small impact from a regulations perspective. Increases in taxes certainly are a net negative for S&P earnings, but today we'll show you is, number one, how big is that impact and which sectors are most exposed to this tax increase that potentially could happen under a Biden victory, especially if there is a Democratic sweep. When we look at technology, this is one of the sectors that also is at risk with a Biden victory, because there is a lot of monopolistic rhetoric right now about breaking up some of the big tech names. Now, granted, this is bipartisan. This is not a Democratic. This is actually coming from the DOJ, but also immigration. Immigration is a big driver of the employment for technology companies. So these are some of the issues that are at play here for the 2020 election for the technology sector. When we look at healthcare, this is really where there's a big source of contention. Obviously, one side of the Republicans want to repeal APA. They want to remove many of the protections that are in place for Obamacare, while the Democrats, Biden is not necessarily for universal health care as much as Sanders and Warren was. However, he is for expanding ACA. So this is really where healthcare is one of the sectors where we do see some fairly major bifurcation between the two possible outcomes. And look at defense spending. This is also another sector where we expect to see under a Trump and a Republican government to see increased spending on the defense side, while on the Biden and Democratic side, this is really where we see some of the biggest negative impacts to some of the defense companies. So investors in the defense sector should really pay attention to what is likely to happen here in 2020. When we look at financials, this is really where we don't see a substantial change depending on whether your Democrat or Republican government comes into power. The impacts to regulation, as we have seen and the data shows, is actually fairly small. So financials, relatively safe regardless of the outcome of the election. Industrials, this is really where the Biden with the Democratic government has put together a fairly sizable stimulus bill on the infrastructure side, and many industrial names, and we're going to show you which ones we're looking at, are net beneficiaries of this. So this is one that we're paying attention to. Home builders, especially with taxes, Biden is talking about repealing some of the SALT, state and local tax deductions that would, generally speaking, benefit the coastal states, predominantly California, New York, Massachusetts, Connecticut, these high income states where home builders have exposure to those specific states are likely going to be net beneficiaries if those SALT taxes deductions are removed. And lastly, when we look at luxury goods or within the retail space, I want to show you some of the data that we have seen between luxury versus discount retailers that show us that depending on the outcome of the election and where taxes will be, we see a clear underperformance versus outperformance between luxury versus discount retailers. So we'll take these are some of the major election issues that are here on that we are analyzing. But to give you a better sense from an economic perspective, one of the big things is really the coronavirus response. How we expect the different potential parties to enact different policies to give us and what outcomes they have for the election. So number one, the coronavirus response, by far one of the major issues on the ticket right now. So we have on one side Trump and looking for more of giving that power to the states versus Biden and the Democrats want to take more federal control over testing and tracing. And from a fiscal policy perspective, also differing here. You have the Democrats currently with the $2.2 trillion stimulus bill in Congress. Senate has looking at about a $1.5, $1.6 trillion bill. They are fairly close on this front. Do we expect that stimulus bill to come through before the end of the year? It's still looking that that's fairly unlikely at this moment, but the difference in terms of the response is different, and that is likely going to have a different support for the overall economy. The Democrats have a much more sweeping response for both the states, schools, and a broad range of industries like airlines and restaurants that weren't really protected during the first bill, versus the Republicans are looking for more of a restrained response. So that, from my perspective, has one of the largest immediate impacts on our economy. So coronavirus response, very, very important in terms of how the shape of the economic recovery will be depending on who wins this presidential election. On the stimulus front, and when I say stimulus, we're not referring to coronavirus stimulus, we're talking about general stimulus of the economy. This is really where we see on both sides a fair amount of what we call onshoring. So both Trump and Biden support this US manufacturing, onshoring, bringing back jobs to the US. This is both of them have this view. Now, the question is just how they go about trying to do that. Biden has these infrastructure bills. He has a $2 trillion infrastructure bill that he wants to pass, about $400 billion towards clean energy, AI, 5G, infrastructure spending, research and development. These are some of the names that we see are going to be net beneficiaries as a result of Biden's infrastructure plan. So stimulus on the economy, important here. Taxes, this is also where we see a very big difference between the two parties. Biden is looking for higher corporate taxes. He's trying to increase corporate taxes back from 21% to 28%, while Trump reduced it from 35 down to 21. Biden is trying to increase higher payroll taxes for individuals, especially for individuals making over $400,000 a year. He's trying to roll back some of the state and local tax deductions that are available to residents in higher income brackets like New York, California, and those types of places. And lastly, he's trying to increase minimum wage on a federal level to $15 an hour. And that has massive ramifications for certain industries. And we'll talk about which industries have the biggest exposure to that. Versus on the Trump side, our expectation is that if Trump is reelected, there will likely be further tax cuts, which, as I said, what I want to do is I want to show you how taxes have actually influenced S&P returns and earnings per share, because there is an impact, but the impact is actually surprisingly smaller than I think many investors might see. Now, on the China and trade war side, this is another big issue for our economy. This is actually one area where both Biden and Trump see eye to eye in terms of standing to China. They both see the same issues with China. What's very different is how they're approaching it. Trump is going with tariffs versus Biden is suggesting that he wants to have a coalition with allies to pressure China into talking at the table. So one of the things that what we don't know is whether or not that coalition will work. We don't know what the response from China will be, but we do know whether tariffs work or not, and we know what the result of those tariffs are, and that is something that we can analyze, and we will do that here today. So those are the primary issues, I would say, that are on hand for the 2020 election, whether you're looking at it from a investment or sector perspective, or if you're looking at it from an economic perspective, that is on the board right now that we are analyzing. So to take a look at taxes, now this is the one area that, especially if you watch the vice presidential debate, this is the one area where Pence attacked the Democrats substantially on regulations and taxes. And his stance was that higher taxes, more regulation will hurt the US economy. But one thing that we did look at is really just the correlation between higher taxes and number of regulations with S&P returns. We looked at correlation of annualized S&P returns versus taxes and regulation. And what you see here is that the correlation coefficient is actually extremely low. We're talking about in the single digits many times, or low teens. So we're talking about very, very low correlations between taxes, higher taxes, and regulations with S&P returns. So this is the one thing that I want to remind investors, that yes, we have this view, and I think many investors have this view, that higher taxes are bad for the economy, lower taxes are good. And we certainly have seen the the S&P 500 rally substantially since the last tax cuts. We know that there's a significant percentage of the S&P's earnings per share that is due to the tax cuts that Trump put in place in 2018. However, the long-term returns of the market versus these taxes, the correlations between the two are actually surprisingly low. So it is something that many investors believe in, but if you look at the data, it's not as strong and certainly not as clear-cut that lower taxes lead to better gains in the stock markets or vice versa. Now, looking at the different sectors, a lot of investors asking, well, what sectors generally perform under Democratic versus Republican administrations? And generally speaking, looking at the 1970 to 2019, what we have seen is that predominantly healthcare and tech are the two sectors that outperform during a Democratic president or administration, versus consumer staples, materials, consumer discretionary outperformed under a Republican administration. Now, the one caveat here I do want to point out here is that what looks like a very strong tech performance here, a lot of that is due to the dot-com boom. So I do want to make sure that everyone takes that with a grain of salt. But if you look at it overall, what you do see is that you have 6 sectors outperform under Democratic presidents or administrations versus 4 on the Republican side. So this is really where we want, we have this many, 5 and 5. And the reason that we have 5 is because historically we didn't have communications as a sector. Communications and real estate as a sector. So in this particular case, real estate is under the financials, versus right now real estate is a separate sector from XLF, or the financial sector. But it's largely split between the two. As far as the performance goes, there isn't a strong outperformance in the markets for one presidential, I would say, administration versus the other from a Democratic or Republican perspective. So the data does not particularly show that that markets favor one particular it's a Democrat or Republican administration from a market return perspective. When we look at dividend taxes, this is one where we do see some unique impact, if you will, from higher dividend taxes. And that predominantly is not a surprise, that you have the sectors that are more like bond proxies, like utilities and real estate, that will have the largest impact, a negative impact rather, from higher dividend taxes, which is something that the Democrats have spoken about. The consumer discretionary also has a fairly large downside or negative correlation with higher dividend taxes, but I don't necessarily know that that's due to that. I think this is something that's is yet to be seen as to why this is the case, but I don't necessarily know that that's a direct impact of higher dividend taxes. But financials, utilities, real estate, higher dividend paying sectors, generally speaking, are going to be negatively impacted from higher dividend taxes. This is one of the concerns that investors have with Biden's tax plan. And we will look at individual taxes. So Biden is suggesting that after anyone above 400K a year will have higher payroll taxes. And this is really where the real estate sector is the one sector that has underperformed by significant margin under higher income tax brackets for individuals. So when we look at investments in some of these, again, real estate and utilities, the higher dividend paying sectors, these are the ones that are at risk of the high have the largest negative exposure to higher income brackets for both dividends and personal income. Now, one interesting piece of research that we were looking at actually was really looking at luxury versus discount. So recently, discount has been outperforming a fair amount here. Now, one of the things is that we want to show you here is that on the bars above the zero line, this is when discount is outperforming. When bars are below the zero line, this is when luxury, excuse me, this is when luxury is outperforming. And what you see is a fairly strong correlation between when higher income brackets have a higher tax rate versus when higher income brackets have a lower tax rate, whether discount or luxury outperform. So when there is a higher tax rate, we tend to see discount outperform. When tax rates are lower, or the highest tax rates are lower, we tend to see luxury outperform. And then when tax rates are higher, we see discount outperform again. So expectation that if tax rates are going higher, expectations are that discount retailers such as Burlington, Dollar General, Dollar Tree, these types of names will outperform versus stocks like Lululemon, Ralph Lauren, Tiffany's, Nordstrom's, those types of names have tended to underperform during higher tax bracket administrations. So if we do see that Biden victory, which again, the polls are skewing in that particular direction right now, that doesn't guarantee the outcome of the election, but certainly skewing to that in that direction, our expectation is that you will likely see discount retailers continue to outperform the luxury retail stocks here. Now, when we take a look at the S&P 500's impact from taxes, this is again where we do see a negative impact to the S&P 500 earnings off of Biden's proposals. So he has a few different proposals on the corporate tax rate perspective. Number one, he wants an outright higher corporate tax rate from increase from 21% to 28%. That has one of the largest impacts to the S&P 500's earnings per share. It's obviously very different across the sectors, but across the S&P 500, that averages to negative 9.2% of earnings per share. So S&P 500 would expect to reduce their earnings per share by about 9.2%. So think about what a 9.2% decline in the S&P 500 would relate to from an earnings per share perspective. Now, this is just earnings. You can still have multiple expansion to make up for that. However, we do see that higher corporate tax rates will have a fairly negative effect on the S&P 500 earnings. The other big thing on Biden's ticket is really the global intangibles low tax income. So this is really where U.S. companies with foreign subsidiaries making revenues of overseas and not having to pay taxes on it until they repatriate their funds. So for example, Apple is one of the largest beneficiaries of this type of tax, where they have their subsidiary in Ireland, where the local corporate taxes are extremely low, and they book most of their international revenue in Ireland, and they don't have to pay taxes on that until they repatriate any of that here in the US. And that's why they have a lot of cash overseas. This is really where the impact on the overall S&P 500 is fairly small, with the exception of the technology space, which is predominantly one of the largest users of this tax deduction. Lastly, Biden is looking for a 15% increase, a 15% minimum tax to all corporations making at least $100 million in revenue. Fairly small bar for S&P 500 companies, so pretty much every single S&P 500 company is affected by it, but the net effect is fairly small. Only about 0.5% of earnings per share will be affected by this last part. So by far, the biggest one is going to be the higher corporate tax rate. So just to look at the individual sectors and see who has the largest exposure. So when we look at, like I said, that the repatriation tax, being able to keep your profits overseas until you repatriate, the biggest impacts on that is going to be healthcare, technology, and communications. Uh, above average impact versus the S&P 500. When we look at the higher corporate tax rate, like we said, this is a uh, fairly small. Sorry, this is a higher corporate tax rate. This is by far the largest impact of the S&P 500 earnings, and you have quite a few different sectors: communications, industrials, consumer discretionary, financials, energy, materials. These are all sectors that currently have a lower tax rate that will be impacted fairly significantly to the downside as a result of this higher corporate tax rate. Now, as far as the 15% minimum tax, that has a fairly minimal impact, predominantly around consumer discretionary, healthcare, and tech. So what you generally tend to see is that consumer discretionary, technology are going to be two of the industries that are going to be impacted the most by these types of increases in taxes across S&P 500 names. So when we're looking at this, we can get a better sense for which sectors have the least amount of impact, and which ones have the largest impact. And from and from my perspective, technology is definitely going to be one of the largest net um, impacted from this. Communications, consumer discretionary, and information technology will certainly have the largest impact. And the smallest impact will actually be real estate. So real estate investors not going to feel as much from these increases in corporate taxes, but more so from the personal income and dividend taxes. Now, one of the other issues on hand is really the federal minimum wage. Federal minimum wage, I think, is somewhere around a little over $7. Biden is suggesting that he wants to move it to 15, which many states have already adopted 15. So it's not something that's going to affect all states equally. There will be certain states that will be affected substantially more, but this will also affect certain industries substantially more, especially industries that are more labor intensive, consumer discretionary, industrials, consumer staples. These are the sectors that have the most employees for every $1 million in sales. And those are the ways that we can measure which industries are most sensitive to employee to margins as a result of an increase in minimum wage. Now, I will take a look at some specific industries, so specifically restaurants, are some of the industries that are being most heavily impacted by this move. Which sectors, which specific restaurants we see has some positive and negative gains, we'll show you that here in a few minutes. But minimum wage, also one thing that we want to take a look at. I do have this industry performance, which is similar to what I just showed you before on the sector level. We do have this on the industry level. So I'm not going to spend the time going through every single industry. So I did put the slide in here so that if you want to review it on your own, we will make the slides with this recording available so that you can take a look at this on your own. If you're investing in any of these sectors or industries, you could take a look at whether they generally perform better under a Democratic or Republican administration. Now, the trade wars. This is a big part of some of the volatility that we saw in 2018. So one of the things that we wanted to take a look at is really just which sectors were hurt the most by the trade wars, specifically the tariffs that Trump put in place in 2018 and 2019. And what we see here is that the vast number of S&P 500 companies, almost 80% of S&P 500 companies reported that they had a negative impact from those trade wars, versus just a little over 20% said they either had a limited or positive impact, or they were able to mitigate whatever impact through passing on those costs to their customers. So as you can see, by far, trade wars or the tariffs that Trump put in place had a substantial negative impact on the S&P 500 names. And we also see capital expenditure decrease as a result of these tariffs. So this is something that's very important in terms of both Biden and Trump agree that we need to stand up to China as a country. And how, but the question is, how do you go about doing it? And for the most part, Trump has relied on tariffs to push his agenda. Biden's claims that he has a different a viewpoint on this as far as how he would push this agenda, but that is something that's yet to be seen as to whether or not he's going to be able to execute on that. But the one thing that we do know for sure is the fact that ever since the Trump tariffs, we have changed our weighted average tariff rate on China from about a little over, a little under 5% to about a little over 20% here in the past couple of years. So a substantial increase in the amount of tariffs that we currently slapped on China. And China has done the exact same back to us. So the net beneficiary to both countries is unfortunately a substantial decrease in volume in trade across both countries to each other. And this is really one aspect that, from my perspective, hurts our economy. When we trade less, we're not going to be able to access the same goods for the same price. Things are going to get more expensive. And that's exactly what we have seen over the past couple of years. So one of the big questions for the election is really, how does the outcome of the election potentially impact this? Would Biden decrease tariffs? That is one of the agendas that he certainly may have. We don't know. We don't have a lot of clarity on this front. But with Trump, we certainly don't expect them to roll back any tariffs under the Trump administration. If anything, possibly even continue to increase that tariff. And we have seen the impact of those tariffs, a substantial decline. And this decline happened well before the coronavirus. As you can see, the impact is actually larger than what we saw during the 2008 financial crisis. So these gray bars were the dot-com boom and the great financial crisis that we had in 2008, 2009. And notice how the amount of decline that we had in trade across our two countries have declined significantly more than both of those combined. And that is a concern for many investors, especially longer term. Short term, this could perhaps benefit a few select industries that benefited from the tariffs, but long term, this is a net detrimental to both countries in the long run because of the loss of trade. And one other big issue on the ticket is really the fact of the environment and climate change. So when we look at the sectors that have the most carbon emissions by sector, it's actually surprisingly not energy, it's actually utilities. This is really where we see utilities will have a very large impact under a Biden administration, where one of his big initiatives is going to be battling climate change. Whether you believe in climate change or not, it is happening, or rather, how it's what is causing the impact, what is causing climate change. I think there is different views on that front, but I think everyone can agree that climate change is happening, and the fact that Biden's plan is trying to address that by increasing regulation, increasing taxes on the sectors that are emitting these carbon emissions, and also at the same time creating a lot of opportunities, in my opinion, to move towards a cleaner, renewable planet. There are, from my perspective, I want to look at this more so from a net positive for those sectors that will actually benefit from this, rather than the net negative, because the net negative is the fact that regardless of whether you look at the Obama administration, the Trump administration, Republicans, the reality is that the use of oil has already peaked. We have peaked in the US. We are no longer going to go back to that peak. We know that for a fact. Global production will still continue to be there, but it will continue to decrease over the next 10, 15 years. There's no doubt about that. So from a Biden perspective, he's looking to the future. He's looking for, how do we shift the energy sector, which is already less than 5% of the U.S. economy, of the S&P 500, into a sector that is growing, which is renewables. And that's really some of the places that I think is worthwhile taking a look at, rather than saying, a Biden victory would be bad for energy or bad for utilities, which it generally will be, but also what are the net positives as a result of that? And I see way more positives out of our move towards renewable and focusing on the environment, rather than the negatives that we see from energy and utilities as a result of a Biden victory. So that's how we're currently looking at this from a big picture perspective. Those are the general, I would say, big picture issues that are on the ticket, as far as how we're viewing them, which sectors tend to have the largest impact across taxes, across regulation, across an environment. Those are the big issues. But let's take a look at individual sectors. Let's take a look at, and what I've highlighted here are some of the individual sectors and industries that have a fairly large variance between the possible outcomes of this election. So first, when we look at banking, this is really where we see the higher corporate tax rate and and regulation across the Biden/Democratic government is likely going to have a negative impact on banks. It's going to impact their earnings. It's going to impact their growth rates because the Democrats are not big fans of big banks, and also their climate plan is generally speaking a net negative for a lot of big banks that have quite a bit of exposure to the energy space. There's a lot of debt out of the energy space, and banks are predominantly the ones holding that debt. And this is really one of the net negatives to the banking sector as a result of Biden versus a Democratic victory. On the Trump side, we see further deregulation. We see further potential growth or accelerated growth from the banking sector as a result of this. But the one thing that is a huge net negative for banks with the Trump and Republicans are really just the trade wars. The trade wars have put a substantial amount of pressure on the banks. We saw it in 2018 and 2019. Financials, one of the worst performing sectors. So this is really where we don't particularly see a lot of upside here for banks, even under a Trump and a Republican government here, because of potential further trade wars that could offset a lot of the deregulation and growth that the Republican administration has supported growth in that banking sector. So banking, one that we see some substantial variance between the two possible outcomes. The next biggest one is cannabis, right? So we know that the Democrats are far more in support of decriminalization and possibly even federal legalization. I would say 2018 was a big year for cannabis. A lot of that died out in late 2019, 2020. Most investors aren't even looking at cannabis. But under a Biden victory, especially under a Democratic victory, this is really where we see the biggest potential net positive for the cannabis industry for possible legalization. If that does happen, that would, I would say, put a huge boom on some of the large players here. Canopy, Aurora in the cannabis space. Under a Trump and Republican administration, this is really the least favorable outcome for the cannabis industry. However, one of the things that I do want to point out here is due to the coronavirus, more and more states are having larger and larger funding gaps. And many states are looking at legalization of marijuana or cannabis as a way to increase taxes or increase tax revenue, and also potentially can increase tourism in that particular state. So this is really where, even under what we consider the most restrictive and the most negative outcome for the cannabis industry, we still continue to see a push towards decriminalization and possibly even legalization in many states, just simply as a result of needing the tax revenue. Will we see a federal legalization under the Trump and Republican administration? That is least likely, but we will see likely states will move towards deregulation, and possible legalization under certain states because of the funding issues that many of these states have. When we move over to consumer finance, this is really where, because of the strong fiscal response that we expect to see under a Democratic government, the $2.2 trillion bill that has already passed Congress, or the $3.5 trillion bill that they tried to pass before that, this is really where we see a lot of the consumer finance names are going to have a very strong net positive, especially the names that have a substantial amount of exposure to consumer credit, such as Synchrony Financial, Discover, even American Express as a broader name, would generally speaking benefit from a larger stimulus package for consumers. Under the Trump administration, this is really where the stimulus, generally speaking, affects higher income brackets. So names like American Express are ones that we see as a net beneficiary. The broader names that have exposure to a wider income bracket like Discover, Synchrony, will less likely be a net positive. But American Express, any of these consumer finance names that cater to more of a higher income bracket, which predominantly is limited to American Express, those are the names that will likely see a net positive from that. When we look at gaming, and when I refer to gaming, I'm referring to casinos. This is one where the trade wars is an important piece of, or an important element to just to give us an understanding as to what is favored from the gaming perspective. This really comes down to the 2020 Macau gaming concessions that are up in 2022. Under the Biden Democratic side, we see this as a potential net positive. We think that that is likely going to continue through 2022, and this will be net positives for any of the names that have large exposures to Macau. Wynn, Las Vegas Sands, MGM. As far as under Trump and a Republican administration, this is really where we see the trade wars is going to have, from our perspective, a fairly large negative impact on those 2022 Macau gaming concessions. And names like Wynn and Las Vegas Sands that have a high amount of exposure to Macau will likely be depressed and have a negative downside pressure on those names as a result of, directly as a result of the trade wars, because this is really one area that we think China is going to use as a as leverage for the trade wars, if you will, is perhaps removing some of those Macau gaming concessions for these American companies. When we look at the healthcare side, this is really where, from healthcare perspective, very, very large difference between Democrats and Republicans. You have on one side, Democrats are concerned about government takeover of these the names that are mostly exposed are Medicare. Medicare exposed names are actually going to be likely the net positives, because the Democrats want to move towards some type of universal health care, whether it's expanding the ACA, expanding Medicare. Those are the names that are likely going to be net beneficiary. Now, on the Trump side, it's going to be a net positive for the industry if you have a Republican government for the healthcare industry. However, if Trump is successful in repealing the Obamacare ACA, that is really where we do see a large negative impact for the healthcare industry if that was to be repealed. Now, he has been trying that for the last 4 years. He hasn't been successful, even with a majority vote in the Senate that has not been able to be passed. So that is not very likely, but just in the event that ACA is repealed, that is where we do see a net negative for that industry. When we look at the internet type companies, and we're talking about Facebook, Google, Amazon, these types of names, we are concerned about a breakup and some of the monopolistic rhetoric that we have seen out of the Democrats. Now, granted, many of that is actually bipartisan. It's not just Democrats. So we do see concerns here for both possible outcomes of the election for many of these internet companies, but on the Biden and Democratic side, we also see higher taxes as a concern. As we showed you before, that repatriation tax issue for tech companies is one of the largest impacts of tax rates for the technology companies. So we do see a larger net negative under the Biden administration versus a Republican administration, where Trump, we still see some of the same antitrust issues. We still see the concerns of social media companies like Facebook, Twitter, Google, that are likely going to have antitrust issues that are being brought up by the DOJ. So we see both of these administrations having a net negative impact on the internet companies, but just more so here on the Biden side. When we look at infrastructure, this is really where one of the things I was saying before, Biden has put together a $2 trillion infrastructure plan. Now, granted, whether or not he'll be able to pass that is a completely different issue, but the $2 trillion infrastructure plan has a lot of net beneficiaries. Everything from equipment rentals like URI, the biggest equipment rental company here in the US, to construction companies like Caterpillar and Deere, engineering firms like Jacobs Engineering. The only net negative is really the tax benefits that some of the names in this particular industry have benefited under the Trump administration that is going to see a net negative, which is names like Waste Management. Some of the waste type companies have been one of the largest net beneficiaries of those tax cuts. We do see some net negatives here on that front, but overall, infrastructure, construction, these types of names are likely going to be huge net beneficiaries as a result of under the Biden and Democratic government. Under the Trump and Republican side, this is really where further trade wars with China is a net negative here for the industry. We do expect under the Trump and Republican government that will likely escalate those trade wars. especially through tariffs. And we see that as a huge net negative for this particular industry, because this is one that China competes very heavily with the US on. This is one of the sources of contention. China is looking to become a leader in many of these industries on their own outside of the US. So this is really, and this is one of the largest drivers of the Chinese economy. So when you have trade wars with China on this front, one of the losers are going to be some of our industrial names here in the US. When we look at energy, this is really where we certainly know that the Biden and Democratic side is for substantially more regulation on the energy side, whether you're looking at the exploration companies, whether you're looking at the midstream companies. This is really where we see a net negative for the whole industry. Now, this, from my perspective, has been happening well before Biden came into power. I'm sorry, well before Biden is potentially going to be in power. This is an industry that has been in decline during the Obama administration. It has been an industry that has been in even more decline during the Trump administration. This is simply just an industry that is slowly dying. There's no doubt about it. There's no, we know where it's headed. The question is just how fast is it going to get there? And it's likely going to happen a little faster under a Biden and Democratic government rather than Trump and Republican government, which is for further opening up Alaska and some offshore drilling. It's going to provide a favorable regulatory environment for energy. However, I think what that's only going to do is potentially slow the bleeding, if you will, a little bit, but it's certainly not going to reverse anything from a longer term perspective. So when we look at this from a longer term perspective, Biden and the Democrats are going to accelerate the decline in energy. But what that's going to happen is that's also at the same time going to accelerate investments in some of the infrastructure names that we just spoke about, but also renewable energy and utilities. And that's what we're going to talk about next. On the utilities front, Biden's specific initiatives on climate change has massive ramifications on technology names, whether we're talking about semiconductor names that are generally speaking beneficial to electric vehicles, AI from the technology perspective, 5G from a telecom perspective. But from a utilities perspective, you have quite a few utilities that are on the renewable energy side. You have Nextera Energy, you have Sunrun. These are both renewable energy utility providers. These are the ones that are going to see the largest net beneficiary under a Democratic and Biden victory. Versus on the Trump side, you're likely going to see further tax cuts, and those are going to generally benefit the higher tax payers on the utility side, predominantly names like Southern Company and Pinnacle West. These are some of the utility companies, the older utility companies that are paying higher corporate taxes, also potentially rolling back some regulations that could potentially help some of those names. So from my perspective, renewable energy certainly is going to be a topic that we're going to be talking about for the next 5, 10, 15 years. So from under a Biden victory, I think what you're just going to see is an acceleration and investment in that particular environment, rather than just, again, slowly stopping the bleeding on some of the older utility providers that use predominantly coal and fossil fuels to generate that electricity, versus cleaner, such as whether it's nuclear or renewables such as solar and wind are ones that we are paying attention to. Lastly, to talk about restaurants. So when we talk about minimum wage, this is really where the restaurant industry is the one industry that will be most sensitive to the increases in minimum wage. And we can look at case studies like McDonald's. If you look at McDonald's in countries that have, generally speaking, higher minimum wage, the unfortunate side of that is the fact that McDonald's has replaced human beings with robots or machines in some of those higher places in the world, whether it's within the United States or outside of the United States, where they have replaced human beings with machines because minimum wages are very high. So this is one area of where it's going to have some negative impact on the restaurant industry, but it's also going to have some positive impacts on the technology side. It's going to have some positive impacts on the automation side, but there's no dancing around this. Names like Darden Restaurants, Blooming Restaurants, Cheesecake Factory, these are the types of names that will have a huge net exposure to their margins as a result of higher minimum wages. So, like I said, plenty of states that are currently already at 15. So for those states, not a huge impact, but there are still plenty of states, that are in the $7, $8, $10 range in terms of minimum wage. An increase to 15 is a very large percentage. That's going to put a fairly substantial dent in the margins of these types of companies. So restaurant stocks extremely sensitive to a potentially democratic outcome. Granted, it may not happen immediately because this could take a couple of years, maybe even longer before Biden can potentially pass regulations on this. But this is really where a democratic sweep would really move towards that fairly quickly versus Biden with a split government is less likely to be able to move towards that front. On the Trump side or the Republican side, this is really where we continue to see lower taxes on this particular space, where we might see even further lower taxes for restaurants. This is generally going to be a net beneficiary for restaurant stocks, with the exception of some stocks like Starbucks that have a fairly large sizable exposure to China, and further trade wars with China will likely be a net underperformer here for names like Starbucks that have this large exposure to China, or have a large number of chains in China. Starbucks with almost 5,000 stores planned in China. If we further get into some trade wars with China, likely Starbucks is going to be a net is going to be exposed from that front. When we look at retailers, this is really where the stimulus that the Democrats have put in place will likely benefit many of the retailers that focus more on the lower income households. So if we look at Aaron's or Big Lots, those are some of the retailers that focus more on the lower income brackets. Those are the ones that are likely going to outperform as a result of the Democrats, versus a lot of the tax increases that the Democratic side has put forth with Biden. They're going to hurt a lot of the names that have most of the domestic exposure. If you look at names like Burlington, Ross Stores, Macy's, Nordstrom, Kohl's, these are names that have almost 100% exposure to US without a lot of international revenue, or if in some cases zero international revenue. Those are the ones that are going to be hurt the most from a retail perspective under a Biden and Democratic victory. On the Trump side, this is unfortunately where the trade wars will likely have a larger impact, specifically on names that do a lot of their manufacturing overseas in China. So if we look at American Eagle, if we look at Abercrombie and Fitch, Gap, these are the types of names that have a large amount of offshore manufacturing on their books. So this is where we see the largest net negative exposure here for retailers. And then lastly, when we look at semiconductors, this is really where we see the largest amount of, what's the best word for it? Semiconductors is a very complex, I would say, industry to analyze at the moment, because again, both Trump and Biden agree of onshoring and bringing manufacturing back to the US. And most of our semiconductors are manufactured in places like China. And a lot of the intellectual property when we talk about trade wars, that's escalating now to what we call the tech wars, because both US and China are fighting for technology dominance. And one of those spaces that China is battling us on dominance is in the semiconductor space. This is really where the US has been the predominant, or has been the only innovator, if you will, on the semiconductor space for decades. And China is slowly trying to invest in this particular space to catch up. There are many concerns about intellectual theft in terms of intellectual property theft from China's perspective. And this is really one area of the economy where both Biden and Trump want to bring back to the US. So this is a complex and shifting industry that's difficult to analyze, but when you look at it, trade tensions and onshoring, bringing back some of this stuff to the US, is really going to, generally speaking, benefit some of the manufacturers that will allow the US to duplicate some of the manufacturing back on the US. If you look at Lam Research, you look at Applied Materials, Intel, these are the names that have the largest exposure and have the ability to bring manufacturing back to the US, or currently do a lot of that manufacturing in the US. And then you also have a lot of these names that are in the 5G space, in the autonomous vehicles space, semiconductors that will generally benefit under the Biden climate change plan and the onshoring plan is really ADI, NXPI, ON. These are some of the semiconductor names in these specific in these specific industries that will generally benefit from Biden's climate change and infrastructure spending bill that we see. But again, semiconductors, very complex space. It's important that you understand that semiconductors is a very, very wide category. Within semiconductors, there are manufacturers, there are firms like NVIDIA versus AMD versus, some of these names manufacture their own chips. Some of them don't manufacture their own chips. Some of them rely on manufacturers like Taiwan Semiconductors to do their manufacturing. So there's a lot of complexity to this industry. So if you're an investor in this particular industry, I do advocate that you do a little bit more research on the different types of semiconductor companies, what type of semiconductors, what type of chips they make is also important. Where do they do their manufacturing? These are ones that you really want to do your research before you invest in some of these semiconductor names. Under the Trump side, like I said, onshoring and trade tensions will likely be a net beneficiary for many of the same names, but we do see potentially also 5G being a big player in this particular space, especially with Trump and the trade wars that we're currently having with China and Huawei. This is generally going to be a net beneficiary for names like Marvell and ADI. So again, semiconductors, extremely complex space, but one of the industries that we think is going to have the largest impact, regardless of whether you have a Biden or Trump victory or a Democratic or Republican government, because at the end of the day, US and China are at war on this front from an intellectual property perspective, and both countries are looking to protect their companies from that perspective. And who is going to be a winner and loser is a complex problem to look at. So I encourage, if you're an investor in semiconductors, do a little bit more research as to the companies that you're investing in, what they're really exposed to, whether they're a manufacturer, whether they are more of an intellectual property company. These are important factors to understand before you invest in some of these semiconductor names. So I know that I covered a lot of things here today, but the US election is at this point a very complex thing to analyze. So what we did try to do is give you first a broader view as far as what are the issues at hand, which sectors are generally speaking most exposed to the major issues at hand. But like I said, taxes and regulation, generally speaking, certainly has an effect, but the net effect is not particularly strong. It's not as huge as many investors may believe. And we do see a large amount of potential positive and negative outcomes on all of these different industries, regardless of who wins this election. But the biggest concern that I think many investors have outside of the longer term views of these specific industries that we covered is really that contested vote. If on November 3rd, we don't have, we have a contested vote and this has to become a legal battle. And whether this is a legal battle that goes on for a week, a month, 2 months, 3 months, longer than that, that is really, I think, the biggest concern for many investors going into that election. We know that Trump has stated that he won't commit to a peaceful transfer of power if Biden is elected, and that is, from my perspective, the biggest risk that we see. And this is why some investors have bought some of those out of the money puts for that November expiration to hedge this potential downside risk that contested votes do have a negative impact on the markets. We have seen historically that contested votes, generally speaking, have had about a negative 5% impact on the S&P 500. But if we have a longer protracted battle here, that could be larger into that 10–15% range. So that is what I think is on many investors' mindsets. And I hope that this was helpful in giving you a broader sense for what is likely the impact the markets will have on these possible outcomes for this election. So with that, what I'll do at this point is I'll try to open this up for Q&A. Again, like I said, I know I covered a lot of things here today. I don't expect everyone to remember everything, but that's why we record this, and we will make the slides available to you afterwards so that you can review this on your own and follow along using the slides so that you can review that information and potentially send us some questions afterwards. With that, thank you so much for taking the time out here this morning. Let's just take a look at the markets and see where they've opened up. So one thing I will say that QQQ managed to break back above that major resistance level that we talked about, 282.5. SPY broke out yesterday, actually, so one day before the QQQ above that 343 level. So we now have both the NASDAQ and the S&P 500 breaking out higher above the major resistance levels that we talked about over the past few weeks. This puts the markets into more of a bullish tone here, especially when you see small caps joining that rally. You see equal weight at RSP also joining that rally and seeing substantial amount of strength. This leads me to believe that there's a lot of health to this market rally here. So this is a substantial change to our views here on the markets and the resumption, if you will, of this bullish trend that we've been looking for quite a few weeks, but we didn't really get until confirmation this morning. So I really would like to see the NASDAQ close above this level here today, and then see markets resume that bullish trend here to next week for us to really start taking much more of a bullish view here in the markets and expecting that we will revisit these all-time highs. So with that, again, like I said, any questions regarding the things that I went over here today? No, I am not a new house. I am simply away for the weekend up in a cabin in the woods, taking a little bit of time outside of the city. So I'm in a different location here for today. Kent is saying, I'm loving your mentorship and the platform, tremendously helpful. My question, when you personally are buying a debit spread, do you always stick religiously buying the 50-60 delta and selling the 10-20 delta? Likewise in credit spreads. Kent, yeah. You know, the only thing that you could adjust depending on your views is really that short strike, but I would always buy that 50-60 delta as a starting point. You know, you can always adjust this a little bit, right? But usually the adjustments that you make is you buy maybe a 45 delta. If you're looking to reduce your risk, you can buy slightly out of the money call or put. And then you can also reduce your risk by buying a slightly closer delta, maybe selling a 25 delta. But those are the minor adjustments that you would make. But selling credit spreads, yes, almost always selling the 50, buying back to 25. Jamie is saying, I sell front month puts to generate income. Should I lay low with the upcoming earnings and election? Or does the increased implied volatility give me opportunities? James, I think it's a double-sided coin. Coin, you have the increased volatility that gives you more opportunity, meaning generating more yield, but it comes with more volatility. So I think you need to strike a balance here. Selling puts, front month puts, especially going into the election and earnings season is a bit of a concern for me, especially if you look at seasonality. October tends to be actually a weaker month here going into the election year. So I do see some downside volatility coming up here over the next few weeks here. But you know, the extra implied volatility does give you an extra buffer here. So it really just depends on your views in terms of, you know, how contested this election will be. And many investors do feel that this is going to be a fairly contested election. So that is one thing that I want to pay attention to here for the markets. Bob is saying, remember that the USA's economy is most closely tied to Canada, especially in terms of energy. Bob, so absolutely. So, but I think the overall view here on energy is regardless of who's in power, regardless of who our energy so I mean, but keep in mind that when you say we're most closely tied to Canada, energy is a very small sector of our economy now. You know, energy used to be almost 30% of the S&P 500. Now it's less than 5%. And that trend I don't see reversing anytime soon, nor do I think that energy is going to come back, you know, especially if you look at the initiatives that are happening in the US here with California. Look at what China just put in place. This is long-term a net negative for the energy space. Tony, there are not states at $15 an hour. There are some countries or municipalities. So New York City is at $15 an hour. I'm pretty sure there are places like San Francisco and California that are in the $15 an hour place state. You might be right that there. I'm sure you're right from the fact that there are no states with $15 an hour, but I think there are plenty of cities with $15 an hour, and there's certainly plenty of countries in the world with minimum wages above $15 an hour. Jason, you're very welcome. Lisa, thank you so much. Robert, thank you. How do you create an out-of-the-money protective put for the elections? Great question. It's not that difficult. So here's my view here. If you want to buy an out-of-the-money put protection, we actually have a webinar just on this, so you can follow us here on YouTube, and we can actually show you this. But you would simply buy, I would be looking at going out to at least November, possibly December, and I would be looking at buying maybe somewhere in the 320 range or so. If you're looking to buy that out of the money call option, out of the money put option here, 320, 325, somewhere in that range. This will give you kind of this catastrophic insurance, if you will. So if markets decline, that 10, 15% on a contested vote, you will see, this type of put option provide you with some downside protection. Dorothy, thank you so much. Like I said, yeah, a lot of information to digest. It took me hours and hours to put this together. It takes a lot of time to go through it. I don't expect everyone to remember everything I just said. That's why we make these. That's why we record these and make them available to you afterwards. Does NDX correlate to the Qs? The NDX and the Qs should have about a 99% correlation because the Qs is the NASDAQ 100 index. It's the ETF on the NASDAQ 100 index. So they should have 99, 98% correlation. I buy leaps and sell calls against it. Any thoughts on why one should even consider owning the underlying as opposed to this approach? Satish, I would say the biggest reason against leaps is the fact that you have time decay, right? It's certainly cheaper to own the leaps versus buying the stock, but when you own the stock, you have no time decay, and when you own the stock, you earn dividends. With leaps, you don't have any dividends, and you have time decay. And the other thing is the fact that if your short call on a leap gets called away, you can't just exercise your leap and satisfy the short call. You have to buy the stock you have to buy back the stock on the short call. So there are just a lot of complexities to buying leaps and selling calls against it versus owning the stock and selling calls against it. If you're an active trader and you're comfortable with that, by all means. But it really just depends on how comfortable you are with having to actively manage those short calls, because you have to be a lot more careful with a short call and leap than you do with a cover call. I've been enjoying the membership. Would you consider providing a watch list of bullish or bearish opportunities based on either a Trump or Biden win? I can certainly put together that list based on my presentation here today of certain stocks that are generally net beneficiaries of a Trump win versus net beneficiaries of a Biden win. I'll take a look at that and try to put that together for you guys. Ivan, thank you so much for that feedback. Clark's on the snap trade, are you going to hold until expiration or sell 21 days before? We never hold a short credit spread to expiration. So we always exit at 21 days if we don't already hit a take profit or a cut stop loss level here. So for Snapchat, which I haven't looked at this morning yet, looks like we're still, it's still pretty much a little bit positive. It certainly hasn't reached the take profit area yet. So we're not there, but we also have plenty of time to go on that Snapchat trade. Kel, thank you so much. I really appreciate it. Geneva, Switzerland, minimum wage now is $25 an hour. So I encourage you to take a look at what does McDonald's look like in Geneva, Switzerland. I bet there are relatively fewer employees working there. There are going to be a lot more screens that take your order rather than human beings because of that. And that is one of the more, I would say, the unintended consequences of higher minimum wage is, yes, it is generally speaking better from a social perspective, but it also forces some of the more labor intensive companies to innovate from that perspective, because if it's easier to have a computer do it, then, you might have to spend $2,000-3,000 investment upfront to buy that computer, but long term it provides you with those savings. As a corporation, you're going to make those investment decisions. So there is an unfortunate or unintended consequence to what is socially a good cause of having higher minimum wage. Satish, Nilesh, thank you so much. I really appreciate this. Clark, thank you so much. Robert, I learned the hard way not to offer to buy dinner in Geneva. It wasn't cheap. Yeah, I could imagine. Many places in Europe are like that. Greg is saying, what do you mean by exit at 21 days from expiration? So when we're selling a credit spread, the general rule of thumb is you exit the trade at whichever one happens first. You either hit your take profit level first, you either hit your stop loss level first, or if you get to 21 days to expiration on a credit spread without hitting either your stop loss or take profit, you should exit your credit spread as well, even if you haven't hit your take profit or stop loss level. Thank you for putting such complex information together and your dedication for teaching us. You're welcome. Thank you for supporting us and allowing us to do this. It is really only because of your support as members that allow us to continue doing this. So we're really excited to, do these members only webinars so that you have a more we can invest our more time in putting these presentations together. Next week, I also have a huge presentation for you guys. Next Friday, I'm going to be doing a technical analysis snapshot. So we have backtested hundreds of technical analysis indicators. We want to show you which ones have the best performance, which ones don't have good performance, what surprising observations we found from that, and there were a lot of surprising observations from that backtest. That is going to be next Friday. That is members only as well. So thank you so much for your support and allowing us to invest our time in doing this and providing this information to you guys. Do you have an opinion on DraftKings? I actually just took a long position here in DraftKings, but and I did it because it dropped all the way down to that 20-day moving average, and I was looking for a bounce higher here, but looks like it's starting to break below that. So I'm not as bullish here on DraftKings, but especially if, the gaming side, I do quite like this particular industry. Gaming we know is a strong industry here. I'm looking for this level to hold. If it breaks below this $50 level, I think it's time to potentially get out of DraftKings. Another one that I was looking at, another one that I was looking at here is Penn Gaming. This one's a little stronger as well, didn't decline as much, looking for that bounce as well, but also breaking below that 20-day moving average. So certainly these gaming stocks starting to look quite weak here. Your platform is awesome. I'd appreciate if you can add a feature to use leaps at 80 delta or adjustable for your income. Satish, why don't you send me an email at info@optionsplay.com just to explain a little bit as far as what you mean by that. David is saying, if he wins and changes the taxes as expected, yet remove the Trump tariffs, what would happen? Is it a net neutral? That's a great question, David. I'd have to take a look at what is the impact to earnings per share from the tariffs, right? Because we can see that the taxes will have roughly about a 10% decline in earnings per share for the S&P 500. We'd have to see what the earnings per share impact of tariffs have been, and the data on that isn't particularly clean. And so we can't easily attribute either gains or losses to earnings per share due to tariffs. We can do it to taxes because that's part of your a balance sheet statement or income statement, but we can't do it on tariffs per se. So that is one area. That's a great question, David. I'm gonna have to do a little bit more research and see if we can do a little digging on that. Thank you so much for all your support. Feedback to move this meeting up by 30 minutes and make it 1 hour so we're done before the market opens. You're absolutely right. So that is good feedback. Like I said, I actually didn't think that this was going to be that long, but I did have a lot to cover with you. But I am glad that I was able to do this. So I'm sorry that this webinar did go into the first 30 minutes of trading. Nilesh, you're very welcome. Leonard, regardless of election result, with ESG focus particularly amongst millennials, is oil and gas uninvestable long term? Is it on a finite life? I would agree that energy is on a finite life. Even regardless of whether Trump or Biden wins, whether I think that's completely irrelevant from the long-term view here of energy. Um, I completely agree. It is on infinite life. Personally think it's uninvestable in the long, at least for the long run. I would much be, and this is one of the sectors that we'll be doing a members only webinar on as well, is the ESG investing, especially on the environmental side. What opportunities we see from the decline in energy into renewables, into electric vehicles, who are the technology players that innovate in this particular space. I'm going to be doing a members only webinar personally because I'm actually quite interested myself in learning more about it. So those are some of the things I'm hoping to bring in here in November and December to help you guys better understand what is the outlook of energy in the future, and how do you invest in that. What are your thoughts on NEO? I've started doing some research on NEO. I don't have a fully formed opinion just yet, but I will make sure that I bring that up during our environmental members only webinar, which is, I know, one of the companies within that space. Herb, Chris, thank you so much. I really appreciate it. It is a nice location for riding. Great unbiased analysis. You have put a lot of myths about political party and economy to rest. You're a voice of reason and earnest in the area of promises and quick money making. I've started the trial and will make sure to convert to a subscription. Pete, thank you so much. I really appreciate that. Thank you so much for your support. Alina, invaluable knowledge. Very much appreciate all your hard work. Thank you so much. I really appreciate it. And thank you for your support in allowing us to do this. David, can you get back to me on that question? David, do you mind which question you're referring to? Because I just spent a bit of time answering your question from above about, Trump versus taxes versus tariffs. Maybe next Friday start at 8:30. I will do my best and see if we can start next Friday at 8:30. Lisa, thank you so much. I really appreciate it. Nilesh, but there would be lots of alternatives we are going to need as utilities transform all EV logistics. You're absolutely right. If we look at the environmental and climate change if you will, there are a lot of opportunities, and that's why I think I want to dedicate a whole members only webinar to just that, because it is going to take us quite a bit of time to research that whole space, give you a good view of the landscape and which specific publicly traded companies can be net beneficiaries of that. So with that, thank you so much. Again, thank you so much for all our members for supporting us and allowing us to do this. And I appreciate you guys taking the time out here, the full hour and 15 to listen to this. I hope that this is useful in giving you a better understanding as to the potential outcomes and which sectors and industries to focus on, which issues have a large impact on the economy and earnings per share, which ones don't have or have a smaller impact. Important information to know as you're trying to navigate this what could be a contested vote in a volatile election. So thank you so much. Have a great trading day. We will send out the recording with the slides after we finish here today in about 30 minutes or so. Thank you so much and have a great day.